Hmm? हाँ मैं फोन कर am I audible? Hello. नाही, बरोबर आहे काय? हॅलो हॅलो
Yes, sir.
Okay, okay, okay. So I already sent a Word file. So we can start today the simulation of part 3. Okay. So you can take a 10-minute time. Okay. And read the entire question and then we will solve together. I already mentioned the answer, I think. Okay, you can just read it. We will calculate. Okay, so can we start now? So first break even point in units. Okay, so what is the formula basically? When you want to calculate the break even point in units, whatever may be the fixed cost divided by the contribution margin per unit. Okay, so fixed cost here is 8,10,000. And what is the contribution margin per unit? 90 minus 63. Sell price per unit minus variable cost per unit. So it is 27. So 8,10,000 divided by 27. This is in number of units. So 30,000 is answer for the first question. Second, in dollar. So 30,000 multiplied by whatever may be my sell price. We already calculated the number. 30,000 is my break even unit. So in for calculation we need to calculate in dollars. So just need to multiply the sell price. So which is 2,70,000. Sorry, 27 lakh. Then unit need to earn desired profit. Okay, so what is the expected profit? Desired pre-tax profit. Okay, so desired pre-tax profit. So what we need to do here? Anyone can guess? Do we need to give the tax impact or what? While calculating the desired profit, first question, whether we need to consider before tax profit or after tax profit. Even if we, I mean, in the question, if they gave the post-tax profit, then you need to first convert in a pre-tax, okay, and then you need to add this amount in a fixed cost, and then divide by the contribution margin per unit or the contribution margin ratio. So here, 8,10,000 plus 1, 8,10,000 plus 1,35,000. So always keep in mind, we need to consider the pre-tax profit. If they gave post-tax profit, then you need to first calculate the pre-tax profit and then you need to consider. So 9,45,000 we need in number of unit. So divide by contribution margin per unit. So it is 35,000. Then next, sell dollars needed for the desired. So again, it is basically 35,000 multiplied by 90. Okay, so 31,50,000. If 1,35,000 is a post tax and the 35% is my tax rate. Okay, so how I can do it? 1,35,000 divided by 1 minus 0.35. So this is my post pre-tax profit. This is pre-tax post-tax 135. On that basis, 2,70,000, 2 lakhs. No, I think yeah, 0.65. So if I calculate multiplied by 0.35 and then yeah, correct. So, from pre-tax, I need to convert, from post-tax, I need to convert pre-tax and then I need to add in a fixed cost and divide by contribution margin per unit for calculating the desired unit need to sell for earnings, desired profit. Or you can divide by contribution margin ratio so that you can get directly sales value. Any doubt here? Next. So here you can write from here only. Okay. So impact on the contribution margin if fixed cost increase by 40,000. So what is the impact on the contribution margin? I mean, there is a increase, decrease or no impact. At least guess. If fixed cost increase by 40,000, then what is the impact on the contribution margin? Any guess? I hope I'm audible. Any guess? Hardik, Harsh, Pooja, Ritika, Tanisha, any guess? What is the formula for contribution margin? Or how you are going to calculate contribution margin? It is basically the sale minus variable cost. So a fixed cost is not impact to the contribution margin. So here answer is no impact. Next one. Impact on the contribution margin ratio if per unit sales and variable cost both decrease by $10. 90 and 63. Yeah. So if both decrease by $10, that means 80 and 53. So is there any impact? And whether it increase or decrease? Any guess? We can calculate simply. Contribution margin ratio. So what is the ratio basically? 27 divided by 90. So it is 0.3. If both decrease by $10, that means my contribution margin is same, but my sales is decrease. So it will increase. Okay. So the answer is increase for question number 3. Then fourth one, impact on total variable cost if the desired pre-tax profit increase by 50,000. Just try to guess so that you can understand how to like answer. So here they ask for a impact on total variable cost, not variable cost per unit. So if the desired pre-tax profit increase by 50,000, so what you need to do to achieve your desired profit level? Any guess whether you need to sell more quantity or less quantity? So to achieve the increase desired profit pre-tax profit level, so you need to sell more quantity 50,000 to achieve the additional profit. Okay. So if you require to sell more quantity, that means your total variable cost get increased. Variable cost per unit may be as it is constant, but the total variable cost increase due to sale of more unit. Okay. So here also increase. So in third it is increase, in fourth also it is increase. Last one, impact on break even in unit if tax rate decrease to 30%. Tax rate decrease to 30% from 35 to 30. So what would be the impact on break even? Any guess? Impact, no impact, increase, decrease? Okay, as I already informed, you need to consider pre-tax profit. Okay, so profit before tax. So whatever may be the tax rate, it will not affect or it will not impact. So answer for the question number 5 is no impact. Anyone has any doubt? See, unless and until you people are not giving any answer, I am not able to understand whether you are, I mean, you are able to understand or not. Okay, so you can take a 10-minute time to read the question number 2 and then we solve. Okay, so can we start now? The first on allocation is unit volume. Okay, so it is a simple means whatever may be the units we are going to produce, that we need to allocate the joint cost. Okay, so we are producing 3,500 and for 3 months and 8,490 for 4 months. Three and four. Okay. So total kerosene produces first 3 months 3,500 and next 9 months 4,260 multiplied by 3 plus multiplied by 9, how much? 48,840. Yeah. And the second one is fuel. How much? 8,490 and 10,000. 8,490 and 10,000. So total quantity 8,490 multiplied by 4 plus 10,000 multiplied by 8. So I just write 80,000. So it is 1,13,960. So total is 162,800. Okay. 162,800. And then what is my joint cost? 45,000. 45,000. So I need to allocate this divided by this multiplied by this. So 13,500 and then this divided by this multiplied by this. So it is 31,500. So these are my answers. So kerosene cost is 13,500 and the fuel cost is 31,500. Okay. So that is on the basis of unit of production. It is given here. Allocation by unit volume. Okay. Next, it is relative NRV. So sales value known at split off. So if we are aware about the sales value, then we need to consider that only. So liquid aspirate, it is 2850 gallons sold at $13 per unit. Okay, so it is like the sales value. Liquid okay, so that is quantity is basically how much? 2850 and the price is 30. Okay, we are aware about the sell price. And then the second one is gasoline. So quantity 1900 and the price is 18. So quantity multiplied by price. Okay, so total 71250 and what is my joint cost? 6500. 6500. So same way, this divided by this multiplied by this one. 3380 again this divided by this multiplied by this one. So it is 3120. So that is my joint cost allocation. Here I am aware at split of point for what value I can sell. So I can use that sell value as a basis. Okay. If I am not aware and I know the end price only. Okay. So then I need to reduce the processing cost. So which is given here. If you see 4,000 pounds sold at 40 per unit, and the further processing cost is 52,000. Okay, so okay, so what is my quantity here? 4,040. 4,040. Okay, so end product price, sell price is this one, and there is a 52,000 is cost, further processing cost. Okay, 2,860. The cost is again here 36,000. 36,000. So on that basis, I may calculate the sell price at split off by reducing the further processing cost. So this is my 240,000, and what is my joint cost? 80,000. So again, this divided by this multiplied by this 44,000, and this divided by this multiplied by this, it is 36,000. Okay, so this way I can calculate the joint cost value. Okay, any doubt here? I mean, we took all three scenario here. Okay, on the basis of quantity, on the basis of sale value, if we are aware at split off point, and on the basis of final sales value. Okay, so we need to calculate the realizable value by deducting further processing cost from final sales value. Okay, so now, so next question. So you can take a, so you can take a 10-minute time. Okay, to read this question.